Hello everyone. In this video, I would like to present a case study about lending club, navigate challenge in stock performance, competition, acquisition, and public perception within the dynamic landscape of peer-to-peer lending industry. This video is about my midterm examination of financial risk management. My name is Yuda Maulana, and happy watching. This case study is about an online credit marketplace that links investor and borrower. It examines the difficulties lending club is facing, such as falling stock price in spite of solid financial result, rising competition, and worries about expansion plan. The story discusses the history of the business, renowned land plans, leadership, and important characters' viewpoint, including Charles Muldoon. It explores lending club's inspection plans, rivals difficulties, and the business's response to the market worries. In the end, the case calls to question the company's capacity to successfully negotiate the competitive environment and sustain sustainability growth in the face of changing market conditions. After reading of the case, I realized that there is four main problems of this case study. Number one is lending club stock experienced a notable decrease, resulting in disparity between the firm's robust financial outcomes and the unfavorable sentiment of the market. Then, the influx of the well-funded competitors intensified the competition, forcing lending club to navigate the delicate balance between maintaining responsible growth and responding to the rapid expansion of challengers. And then after that, lending club's growth strategy was hampered by its delayed acquisition of smaller rivals who had raised significant capital on their own, which reduced the prospect for consolidation in a cutthroat industry. And then the last is being a publicity traded company, lending club came under increased scrutiny from analysts and short sellers. What are the causes of those specific problems? Number one, for the notable decrease, despite lending club's solid financial result, the market might have underestimated or misjudged the company's actual value, perhaps as a result of misunderstanding or worries about industry difficulties. And then for the influx of well-funded competitors intensified the competition, causing the new entrants who were supported by the substantial venture capital were able to grow quickly and challenge lending clubs' hegemony in the market, which led to increased competition. Number three, for the delay acquisition, smaller rivals raised significant amount of money on their own, which lessened their incentive to sell to lending club. The potential for strategic acquisition was altered by this dynamic. And then for the last problem is under increased scrutiny from analysts and short seller. Lending Club was subject to more scrutiny from analysts and short sellers because it was publicly traded company. This individual may have highly perceived risks and uncertainties which influence the market negative sentiment. And also for the communication challenge, the company may have had trouble telling the public and analysts about its growth plan, risk management procedure, and competitive differentiation. The risk of those problems is its emphasis of the responsible growth, prioritizing responsible growth to maintain underwriting and loan organization process may expose lending club to the risk of losing market share to more aggressively growing competitors. And then it differs customer acquisition but because it's relying on the various customer acquisition channel introduce the risk of dependence on external factors such as change in marketing effectiveness, cost, or disruption in specific channel. And then after that, communication and public perception. If a lending club fails to effectively communicate its growth strategy and address concerns raised by analysts, there is a risk of persistent market misunderstanding. leading to the negative perception of the impacting stock market. And then the last risk is delay acquisition. The decision to delay may result in missed opportunities to consolidate the market, allowing well-funded competitors to grow independently and potentially erode leading clubs' market position. To mitigate the risk of losing market, uh, possibly prevent by enhanced communication, improve communication with investors and analysts to clearly articulate the company's strategy. And then to prevent the risk of dependence on external factors could be driven by innovate and diversify offerings, stay ahead of the competition by continuously innovating and diversifying product offerings, and then to prevent the risk of persistent market misunderstanding by strategic partnership instead of direct acquisition, considering forming strategic partnership with smaller competitors. And then the last is to prevent missed opportunity to consolidate the market is by proactive investor relation. Establish a proactive investor relation strategy to engage with analysts, shareholder, and the media's public scrutiny. So that is my analysis and my understanding about the study case of Lending Club. I hope you can get my point and lesson from this case study. Thank you.